Okay, I show it being 9 o'clock. We'll call the meeting to order. If we could have roll call, please.
Certainly. Ring,
Present.
Stars excused, Castile,
Here.
Hines,
Here.
Jennings,
Here.
Singh,
Here.
and Byram.
Here.
Next is the approval of the report from the regular meeting of October 28, 2025. Any additions, changes, deletions? Seeing none, will indicate those are approved. Deborah, anything on member forum?
So there are no in-person forum members to speak, and there are no members over Zoom. That concludes the member forum.
I have no announcements. Jeff?
So one item this morning, many of you probably have heard through the grapevine or seen posts or read something online regarding the restaurant, the Creekside Grill, Bar and Grill. There will be an article in the Rossmore News coming out tomorrow with the formal announcement that the current Creekside Bar and Grill will be coming to a close at the end of this year. Their lease ends the end of the year. They will be operating through December 23rd and then closing so they can transition to a new operator. This has been about a 2-year process that has been in the works where the board undertook a pretty extensive food and beverage study and worked through the community, received feedback through surveys, focus groups. We had a town hall. We did a kind of a food tour, really to understand what the community would support, what the interests are in additional food and beverage operations. We used a consultant called Synergy Consulting, and they really concluded that there is capacity for additional food and beverage service within Rossmore, and their recommendation was that additional service be provided under the umbrella of one operator. So you have the restaurant, current restaurant and bar, and any additional food service would be under one operator. So our goal then was to really find a operating partner. The board authorized the issuance of a request for proposals to identify that operator. And we had several really solid proposals that we received, including one from the existing operator. There was a review of financial strength, review of kind of capacity to expand, review of food, review of process, a whole bunch of different elements, including interviews went on. And ultimately, the decision was made to go with the owner of the Peasant and the Pear, as well as about 3 other pear-themed restaurants. Rodney Worth, he has been in Contra Costa now for many years, well-renowned operator, and he will be beginning and taking over the lease starting in the new year. There will be a transition process where we're going to do, as you've talked about in the approval of the capital budget, there's some tenant improvements that will take place within the kitchen and within the bar and restaurant. And we will be announcing a whole slew of information regarding different elements of the transition process. But the current operator will be concluding what he is saying right now is about the 23rd of December. New operator will begin early in the new year.
So there'll be a period that will be closed.
There'll be a period where
time.
they have to just, in order to clean out and do some tenant improvements.
You don't know you don't have no idea how long.
A lot depends on ABC licensing and health permits with any upgrades.
Okay.
Operations.
Nancy.
So Jeff, you're using the term operating partner, and I understand there's some changes in that. So can you just briefly explain what that means and to what extent Rossmore now has a stake in that, and what our risk might be expanding restaurant operations?
It's still a lease agreement where the new operator will have complete control. We are not in the food and beverage business, but we want a partner that is interested in expanding from the existing site and offering other food and beverage opportunities in the valley. And that will be something we roll out over the next several years. So it won't be immediate that you'll see another, food outlet or beverage outlet, but in a partnership in terms of, we want to make sure it's somebody that is able to grow, able to expand with us.
Yeah, so so the 625 that we approved for tenant improvements, so that doesn't include, for example, adding a cafe, or is that later down the line?
Correct. That is for the existing Creekside location, kitchen improvements, flooring throughout, that sort of thing.
So I'll follow up on that point then. Let's say we want to expand at another location on property. How do you go about deciding how much of the improvements they will put in and how much we will pay for?
So that'll be something that we negotiate with them. As we, depending on where it is, what the scope is, and everything else, there'll be a number of different items that will be into that.
Okay, so now in our current capital plan, we don't have any line items for these new projects as it stands right today?
Not for future
ones.
Improvements. We will be within the capital. We're talking with planning right now, but there is funding for like this complex here to do some planning, and then as that evolves, then we'll have better idea of how.
So as you've communicated back and forth on this, was there any thought as to how soon they would start to consider opening up new places? Would it happen in 26, or are they saying no, it'll be later?
No, it'll.
What the discussion?
So there'll be things like a coffee cart type of deal. There'll be smaller scale, but in terms of a additional food service, that will probably be 2 years out. For example, we're looking at up at Hillside with the lawn bowling and bocce, and would that make a good location? So we're gonna do some studying there. We're gonna do some study here at Gateway. So those are two potential locations. But it'll take time
Take a
to.
while. Okay, all right, thank you.
So that this idea of that being an operating partner, it effectively just means they've agreed in advance that when we want to do something, they will be responsive?
Yes.
Jeff, are there any updates on the medical building or anything on that?
We are finalizing the purchase and sales agreement. Still, it is going back and forth between the lawyers a little bit right now, but that should be finalized in the coming weeks. And then we will be under a contract with the selected buyer.
The buyer of what about us buying a new one? Is that?
That hasn't progressed any further. We were looking at a potential property, but that right now is on hold.
Okay. Is it gonna be a like-kind exchange? We have so much time to fulfill that
We
second
were
part of the
looking
obligation?
at a 1031 exchange, but if we don't secure a property outside the gate, then that
We have so much time after, I forget what, it's 180 days, I forget.
We're
I don't know what it
looking
is.
at a number of different options in relation to
Do you expect the contract to be finalized by the end of the year?
For the purchase of the medical,
The sale of, yeah.
the sale, yes.
Okay, great. Any other questions for Jeff? If not, Todd?
All right, good morning.
Morning.
A lot to show and tell today compared to last month. So not just to inundate you guys with documents that were attached to the published agenda last week. I just want to first kind of run through what the documents now are, and then we'll go through the actual individual components. So with both RPM and RWC, we have basically a budget to actual, and that is where we are through the month to the budget for that same period and a variance. We completed a new report that takes that same information, but now we're looking at the budget to date versus the annual budget. So where the first budget actually been showing you has been based on, October to October. The additional report you'll have this month is it actually shows you through October and then what's left for the remaining of the year. All right, and that is something that's obviously been asked for, certainly on the mutual side as well. It's very much, people want to know how much they have left, right? Because they're not necessarily used to looking at their total budget. So this one will show you what we've spent through October, what is the total annual budget we had put in place for this year, then what's remaining in the 2 months in this case. All right, so that is a new report you haven't seen, and you'll see on the header, it's RPM actual versus annual budget versus actual to budget. All right, so a different way of looking at the information, but I think a very good addition to the deck. All right, so then going through to the next set. After that, we will still provide the monthly income detail. So this is our income statement with each month. So you can see how the variances flow by month and what's the activity in each given month, and still showing the year-to-date total. Then moving down to go ahead.
Can we make any questions?
Sure.
Let him go through the.
Yeah, I just want to kind of orientate you to what's the documents are.
Then we'll come back.
Okay.
Okay, so the new one, obviously, we now have balance sheets. So this is the balance sheet through October. So this has obviously been one of our big goals to work towards finally having balance sheets that actually not just on a consolidated basis, but actually work within the two different pieces. And so, of course, with the balance sheet addition, we also now have a statement of cash flows that we've never had here. So this is now a statement of cash flows, so we can, and just so when you read that, obviously, you can now see where the ending cash at the period here, the 1894. If you go up to the balance sheet, you'll see the cash 1894. So everything is now tied out, and so we have that for RPM. We have that exact same documents for RWC. All right, so we have that same, you'll find in your attachment all those exact same files for RWC, which we'll go through in a minute. So now if we go up to, the top here, and just orient yourself to some of the other ones. On the trust.
Can you refer to the page?
Yeah, let me get there first. Okay, so on the trust, so I'm on page 4, 6B4. Okay, we don't do, technically, we don't populate a budget for the trust historically, right? So there's no budget to actual for the trust because we just basically have the MTFs coming in and we have the fixed asset piece, right? So what right now exists within our financial environment is we have the income statement for the trust, right? And we'll have the balance sheet for the trust, right? And we'll have the cash flow for the trust. Okay, so the 3 primary financial statements are all now here available now on the trust side. So that's pages 4 through 6. And then at the very top of your package, page 1, 2, and 3, we've now done that on a consolidated whole. So you'll see the entire organization. So that's consolidated from the header. You'll see that's Rossmore Walnut Creek, RPM, and the trust. The consolidated position for all 3. We've never really looked at that historically ever, except maybe when the audit comes through once a year, right? So now monthly you'll have a consolidated set of financials, a trust set of financials, and then obviously the same financials.
Is there a consolidated balance sheet also?
Yeah, and so we have a consolidated balance sheet right here.
Okay.
And we also have a consolidated cash flow as well.
So those first three should mirror the audited financial statements. In theory, that's the purpose, okay? Can you go to the next page, Tom?
Yep.
I just want to have a brief, not that one, keep going, keep going. Budget versus actual, the budget versus actual for one of them.
Yeah.
Just go to that one for a second. I want to have a brief discussion. Okay, so we had a meeting and one of the things we talked about is variances. And which variances do we want to look at, highlight? Are we gonna have questions? Which variances can Todd anticipate we're gonna ask and be prepared for? So arbitrarily, and I'm bringing it up for discussion, we picked if the amount over or under budget is more than $50,000 and the percentage difference is more than 10%. For example, the second line, recreation revenue is 33,000 and 6%, don't care. The 55703 is 114%, so it's more than 10%, but it's $233. Didn't care.
Right.
So that's what we arbitrarily picked. So going forward, Todd will use those parameters to anticipate questions that we're gonna have and have explanations for us either in the packet or when we come to the meeting, depending on the timeline. If anyone wants to look at that, doesn't agree with like I said, we just looked at it, 50 and 10%. We can have a discussion on that. Is it too high, too low? Initial reactions? Any comments? Okay with it?
That's great.
Okay with it?
Okay.
Okay, all right, Todd.
All right.
I'll let you go back to your thing. We're gonna keep the 50. Again, our decision, if 3 months from now, people decide, hey, that's too high, too low, we wanna change it to X or Y, we can change it. So we'll start with this and we'll modify as need be.
Yep.
Okay, all right, Todd, I'll
All
talk back
right,
to
let's
you.
go. So we're gonna start with RPM, which is, yeah, go ahead.
I'm sorry, but before you go, so I thank you for these balance sheets. It's really great.
Yeah, it's nice.
Reflects just a real triumph, a lot of work. Page 6B3, so we're talking about the, where's the balance sheet? Balance sheet 6B2. So if I were to look at that, the trust balance sheet, can I find on there the amount set aside for capital assets or funding capital projects? Where is that?
We have not,
It's not booked. It's not booked.
So but we're collecting the MTF
Yeah.
and it ends up here, right? And it's just in the cash amount?
correct.
Yes. There's no like the pickleball, there's no liability set up. I'm assuming there's no liability set up for the pickleball court until as we get invoices from the construction company, they'll be capitalized and reduce cash.
We look at that, and that's part of what Ann typically reports is the cash flow within the various approved projects and the budgets within that. So that's all kind of reported on and tracked, but within here, it's consolidated.
And it's,
And it hasn't occurred. There's no
Right.
Right.
gap,
There's no expenditure.
equivalent
Yeah.
entry required at this point. And I'm maybe speaking out of turn here, but my understanding is that you're looking at creating a forecasting tool out of Workday
100%.
that would enable us to see those kinds of things.
And
So
then-
that you can see, here's where we stand right now, and here's what we've sort of committed to.
Yeah,
And therefore, here's our cash 3 months from now, 6 months from now.
Right, and that would take and that would connect what you if you would expand some of this where you see the work in progress, the WIP where it hasn't been booked yet, you know, the project money is spent. We'd connect that to future spending on a pickleball project, for example, and forecast that out, right? Because then it's really driven off the future cash flow projections, which are, you know, the cash that's sitting here in the village.
And as Jeff said, remember, Ann gives us that statement that says, here's what our cash is, here's what we expect MTF to be, here's all the things we agreed to pay, and it goes out 5 years that we've seen. We saw 2 months ago when we were looking at raising the MTF fees. And she does that on a regular basis. Maybe we can make sure we get it more regular, like every quarter or something like that, that would help. I have no problem with that.
I'm just curious if like we have, let's say we have 9 million in the bank and 5 million in projects, what's the other 4 million for, you know?
There's other projects, if you remember the list, there's other projects going out, and our issue was that the reason why the MTF fees were raised was because we were getting dangerously close to the 2 million threshold that the board has decided they want to keep as their cushion.
Yeah, I understand.
So we'll be bringing the capital budget to you. Right now, the planning committee is reviewing the list and recommendation for projects going into 26. And that will come to this committee in January and the board in January, February.
Okay, does that answer?
Yes, it does.
Okay, all right, Todd.
Okay, so we are on the RPM side right now. And so as Dan indicated, when we sat down in our meeting with him and Adrian, myself and Jeff, and kind of came up with that budget variance. So on the revenue side, we had highlighted billable services for both operating and reserve and landscape on the revenue side, right? So you can see that the operating of 239, the billable services on reserve is 147. And then the landscaping, now those are mostly favorable, but we're down on the operating side. I think everyone in this room understands that is revenue we book for our own internal people to go out and do work either on the operating side or for the mutuals or the reserve, if it's an actual reserve project, right? And also John T. and his crew, if there is additional work that the mutuals request that his crew does, right? And so we create those revenue budgets in the revenue hearing. They are obviously pretty much flatlined. However, it is still an estimated projected number on revenue, right? And so there's no real detail behind this other than we have gotten more. We're short through October on the billable revenue on operating from what we had budgeted through October. We are actually doing more work on the reserve side, and John is doing more work on the landscape side. Yeah, Dan.
Can you please explain to me one more time, probably for the 4th or 5th time, the difference between billable service operating and billable services reserve?
Yeah, it really depends. It is linked to the mutual on what side of the equation the work is done. So if that work comes out of their operating fund, meaning it is repair and maintenance.
Okay.
That is, they have a tile that needs replaced on the roof, there's a leak, or, hey, we're gonna use you guys to go ahead and do all the gutters, and it becomes a reserve spend.
So from our point of view, it makes no difference, and maybe going forward, if we look at those two, we combine them and we realize probably doesn't meet the parameters, but okay.
Mhm.
All right, thank you.
And the
I
other
always
thing,
forget
yeah,
that.
exactly. And then the other thing about that too, you look at how they combine, we are still, with NetSuite, right? We are having the Arun's team, with Luis and all the guys, making sure that we are tracking down things that are also coded correctly on the mutual side in terms of, that should have been booked to reserve, not operating, right? So this revenue, obviously, by having it segmented, keeps those kind of in alignment. Okay. And then same with John T, other than that is just landscape work. And that is actually one that is combined. It doesn't separate between any type of fund. Okay, so those are variances total that's positive. We're doing better than we actually thought on the revenue side. However, there is some, a little bit of a mixed change between what we had planned on operating versus reserve. Okay, going down on to the expense side. So the big variance we highlighted was the employee benefits, which was 102,000, it's kind of hit that threshold. Yeah,
Can you
Nancy?
show the, turn off that AI thing so I can see what page you're on?
Uh, Okay.
It's actually on 17,
Okay, thanks. I just.
it comes from AI.
Thank you.
Good one, Adrian, I like
I just
that.
tell it, I don't know if that,
Now we don't know what page we're on because we don't have AI anymore. Come on.
we're on 17 of 24
All right.
over there in that very far tiny box.
Yeah.
Okay, so when we were meeting, obviously, we saw the variance of employee benefits of 102,731 or 96%, but because of the dollar threshold, we highlighted that one. So what I'm doing on this report, since we've gone through that initial review and we were just highlighting employee benefits, I went ahead and expanded the detail below that account summary, so we could actually see where those variances are coming from in the large buckets, right? So under employee benefits, you'll see that we are, if you look at workers' comp and you look at, obviously, medical expense is a big one we're under. Medical expense, we budget at a full loaded FT, position count, right? And we budget multiple dependents. So that medical expense, depending if we have a position change, and all of a sudden someone doesn't have 2 dependents, right? So there can be some variations in there on the medical side based on elections, right? So we budget at a standard, and then depending on if the position is still open or if it's been filled or someone changes their election, some people have their spouse coverage. It doesn't all go through us. We can see variances there.
So Todd, going forward,
Mhm.
you do not need to do that because it doesn't meet the threshold of and 10%. It's got to be 50K and 10%.
Yes, it's just, I know, I just
I
took the
know.
one.
I just appreciate the extra.
Yeah.
I mean, that's great.
Okay, and so. But going forward, where there is detail and we highlighted one of those variances, I'll go ahead and provide you guys that expanded detail. Okay,
That's great.
okay. The next one we had looked at was the professional services. You will see the professional services was $82,000 under budget or 59% of budget. And where those variances are occurring. Those variance occurrences are in other professional services. I am going back and doing some further research on just the timing of that, but we just haven't had, we're just under budget. So it's a good thing, and I'm having, one of the things with this exercise and flagging these variances is to actually go back to the team and group. And you'll see on the RWC side, some of those questions are not just from my perspective, but also from the senior leadership team in terms of their timing and what they see, right? So, so I am looking at that one a little bit, why we're $875,000 under budget. And making sure it's not just a mapping or that those dollars are somewhere else, right? So, but we're under budget on the expense, right? And so further research will be done on that, just that we highlighted that one because it met the threshold. Administrative expenses, same thing there. On the administrative expenses, we're $136,000 under budget or 57%. A lot of that is sitting in administrative supplies, office equipment, and equipment usage fees. You'll see up there. I'll start with the equipment usage fee. That is fixed asset depreciation that is booked, and Man and her team usually do that in, there's a whole fixed asset piece that needs to be still, depreciation piece that has to be booked over to RPM, right? So that's what that is, and it's usually done at the end of the year. We're gonna obviously try to get it done monthly going forward in 2026. And that's why that variance is there. Once again, we've put it 1/12, 1/12, 1/12. Office equipment and office administrative supplies are under budget. Office equipment, that is a budget issue, or we're not really using that, Jill, when you go back and look at it, and a lot of that stuff is in the administrative supplies. But that is an area that's not really necessarily timing, that is just favorable we're under expended. We need to go back and look at what we've historically spent there and making sure we're not missing anything. Okay. And so those were the areas on RPM that we had highlighted. If you look down on our bottom line, we had currently through October had basically break even, which is what we are, our mission. And we're running favorable right now by 266,000. So we have a surplus right now of 266,000 through October. The next set of reports on RPM, I'm just not going to speak to them very long, but I'm going to highlight them. This actually has the expanded detail for every GL account, but if you look down each line item, you will see exactly what is spent, what the annual budget is, and then what is remaining for the year. So if you were to get down to the very end, obviously we're at 266, but because our budget is break even, right? The total has to be 0. And so that's why you see the 266 over there, because we have $266,000 left. That obviously is made up and has those individual variances by category. So take some time from orient yourself with this, read through these, right? And you can kind of see, and obviously this is so much better detailed information that we can use for future budgeting, for future forecasting, and building the seasonality into our budgets for 2026, which is our next step, is to take our approved annual budgets and now go ahead and spread them through each month in 2026. And this data is a very valuable tool for us to do that. And then to finish RPM, like I said, we don't really need to go in, I don't think, just for information, but not a lot to look at. But on the P&L, we saw the P&L by month.
Can I ask one question on that?
Absolutely, go ahead.
On number 22. October really fell off, total income. And it looks like billable services reserve was running like 100, 200,000, 190, and went down to 81.
It's just less in the winter months. So as we start getting into weather, some of that work can't be done. So you'll see some seasonal timing
So that
variations in that
usually
work.
that happens in around October. Okay.
October, November, December, depending on when the crews are available, right? I know, it comes down to just, available delivery projects, right? If they have not called in and had work scheduled,
Right.
you can see some variations there, but certainly the winter months are a lot slower on that contracting revenue.
Okay.
Yeah, Dan.
I'm assuming you're expecting November, December to give away some of that 200, that surplus. Are you still expecting the year to be favorable with,
Yes,
but it's gonna be
but it'll be reduced.
significantly reduced?
I mean, I think if you look at we're gonna be eating some of those overages we've had in contracting to what David just mentioned.
Yeah.
I think we're actually on board. I don't see a lot of the variances in, like, for example, we were looking at administrative, some of those other things. They're not gonna just all of a sudden go crazy at the end of the year. So, I still think we're gonna be favorable. I don't be put on the record, but I bet it'll be around 100 grand.
Okay.
Probably.
Okay.
But I don't have a 8-ball.
So a question on that. We operate RPM as a nonprofit, a separate nonprofit. And any overage like this, any surplus is then given back to the mutuals. Is that done just by adjusting next year's numbers of the charge, or is it done as an actual?
So that's actually an item within our management agreement now, that we identify that any surplus, we would carry a balance of 750,000 cash balance. And then anything, once we complete the audit for the previous year, we would go back, it would be a disbursement basically, based on a formula for what their pay-in would be.
That's based on cash on hand, not on the income?
Basically,
We maintain a end of year balance of working capital of at least 750,000. So we want to make sure we don't dip below that.
So in other words, if we had $850,000 in cash and $100,000 surplus, we'd give them the $100,000 back. But if we were at $700,000 in cash, then they wouldn't get a penny.
Correct.
But if we were at $850,000 and we had a negative, and we broke even, we would still owe them $100,000.
No,
Sorry, say that again.
If we had $850,000 in cash at the end of the year, but we had no income, we broke even, we would still owe them $100,000 in cash.
So our working capital at year end, we're maintaining is the 750,000. So if we have over that.
No matter what the income
Aye.
statement shows, we owe them.
Well, I don't know that you would make that statement.
Well, but it's based on working capital, it's based on working capital.
well, assuming,
I don't know how you could have both, but I don't know, how much cash do we have? Can we go to the balance sheet? How much cash do we have?
Well, so the cash on RPM is, you know, because of the intercompanies, right? There is it's, you know, the management agreement is basically tied to the, you know, income statement. So on the income statement side, Dan, you know, from, you know, if I was to articulate this, let's say we ended up 850,000 positive on the income statement, right? You could say that is $100,000 surplus to what we had charged through like the management fee and everything else, right? That we were over, right? The over the 750, but to tie it back to exactly to cash on the balance sheet would be extremely difficult given all the intercompanies at any given time.
Okay, I'm confused, sorry.
So I mean, you can't just look at the cash. It would
I thought-
basically, you assume the 100,000s would be in the cash. So if we go to the balance, let's just say that, let's go to the balance sheet, right? Right? We have bank of 1894, right? And right now you would assume that without getting too far in the weeds, that cash balance includes obviously the net income. So if we go to the cash flow statement, right? Cash flow statement, we've grown our cash, right? So therefore, if we were to end the year at the 266, we wouldn't do a refund. If we were in the year at the 850 to your point,
If this was year end,
this was year end,
how
right?
much would we owe them? How much would we, this was the year end, everything's year end, how much would we owe the mutuals? That's my question.
Let us come back with because I want to tie that specifically to the language in the management agreement. So instead of trying to work through, I'd rather come back to you and say, here's exactly the formula, how it works, when it works.
Fair enough. So when we look at whatever we have in January, if you could tell us based on the statements we have, either November or December, hopefully December,
Yeah,
that'd be great.
no, that's a good
That'd be
discussion
great.
topic
It's a good discussion.
That would be great. Perfect.
Alright.
Okay.
And then to kind of finish off on the RPM, since we're on the balance sheet now, right? So obviously we can see, like we haven't ever seen, right? We can see the cash, we can see the, you know, the AP, and then if obviously, as I indicated before, you know, having the balance sheet and the cash now tied to the cash flow and the changes. So now the cash flow, you know, basically from my perspective, and one of the reasons I've been wanting this so much is not just also the information, but also doing it in NetSuite as a closed system is actually working, right? So there's a trust in there factor in terms of, you know, the cash flow statement, which is, you know, for those with accounting backgrounds and non-accounting backgrounds, this is an indirect cash flow statement, right? So it's looking at changes from like taking the net income and then making also the changes in AR and AP, right? So the fact that, you know, we have the cash flow statement tying the income statement, the balance sheet together, and that they match and work, right? And you can see that from these documents. It's just a huge, it's a great tool, and we're just now going to be able to go forward and have, you know, as we start generating some other KPIs, we can incorporate balance sheet information and stuff into a summary report for this group and write some of those reports, yeah.
And the big change in AR is mainly the mutuals, correct? I mean, that's the only customer they have. So that's just the mutual owes 3.5, whatever the number. Go back to the balance sheet, please. $4.3 million to RWC,
Right.
the mutuals.
So one of
Are they good for it?
they're good for it. One of the things I'm going to expand with some of the, like with Jason and stuff now, is there is a separate analysis, I think, for this group and the board on showing the intercompanies and how that stuff all reconciles from a top level, right? So there's kind of a walk or a story on the intercompanies because they can wildly vary because we're taking, I'll use a mutual example, right? Like when they look at their aging reports. We close the period on 10/31, for example, right? So when I run my aging report on 10/31, I have a lot of people that prepay my check and prepay their assessment. So they see all these credit balances, right? And so then you look at the net aging amount. But if I was to share that same report on November 4th, all those would go away now because the November bill has been posted. So in any month, depending on payroll timing and accruals intercompany, and when we actually reconcile those intercompanies. So I think Man and I and Jason are gonna create kind of an intercompany secondary supplemental report that kind of ties the receivables and the payables between the entities, because it's something that it's confusing, but given any point in time, but it's something I think would add a lot of value to confidence and trust, and just understanding. And we've created a lot of intercompanies that are, very confusing in terms of like the setup fees and everything else. So without going down that rabbit hole, that is going to be forthcoming so we can have better information. But today is a huge milestone, the fact that we actually have cash flow and balance sheets, right? And so something we've been working towards diligently. And and so we are still having some little cleanup here and there, but it's very small because we still have to go through the GenArc process so we can get to the point where GenArc can be closed. And then we're not going to be officially done with GenArc until we turn the corner next year because of the field service management piece where all the work order desk comes in, right? So the billable revenue you saw in there and all that kind of process are still being fed from GenArc. As of September 30th, we went live October 1st. So there's still, can't wait for the implementation to finally be over, but we have a few more months left on the last piece. All right, let's go up to, for time, let's go now up to, and I'll tell you the page, Nancy, we're gonna go do the same exercise on RWC. Bear with me for just a second. Okay. All right, RWC. So on RWC, the first thing we highlighted, and you can kind of tell because of media revenue is expanded, we highlighted the fact that we are 110% above revenue on media, or $88,000. So if you look at the expansion of the media revenue, Ann and her team are basically over on newspaper subscriptions and newspaper advertising. Right, and this is an area, like I said, where going forward, once we have this now, like clockwork, we can reach out and get some commentary when we do these variances now from the other SLT members so they can speak to it versus me speaking out of turn and go in, right? But, in terms of what she actually sees, and when she's spoken to it in some of her updates and stuff, but, to have we highlight these variants ahead of time, I can then get feedback now that we have this kind of rule and provide this group and the board with, hopefully answers to their questions. So obviously it's favorable, which is great. And she's obviously no one better than Ann to get as much revenue as possible out of her side of the business. So that's very favorable. Scrolling down, employee expenses we highlighted. Employee expenses of $1,000 under budget or 77% of budget. And if you look at where that is, it's pretty consistent across all the different buckets. So there's not one major driving thing. You can just see that we are, and this would also be where I would want to have, Arnold also provide some commentary, staff training, staff support, some of them are favorable, the T&E, the travels and meal being under, employee uniforms. I mean, you can kind of see across the board where we're under on some of these areas. But then, of course, that then begs to the next question of, do we over budget or are there just true variances and some timing,
Or is
so.
there stuff coming happen in November
some
and
stuff in
December?
November,
That's why
right.
if you, yeah, if
Yeah,
you,
so-
when you can talk to them, you get those
Yeah.
answers and we'll be golden.
Yeah, exactly.
That'd be great. That would be great.
Yeah. All right, facilities maintenance. On the facility maintenance side, we've talked about this. If you look at the once again, the expanded detail, the trust maintenance is a big piece of that of 187,000. That is the paving work and some of the stuff in the trucks expense, which as you guys know, we're gonna be not in this budget in 2026. It's gonna be on the trust side. And so that's a big piece of it. And then there is some mapping issue that I'm researching on coding on the supplies section where some of the stuff is being coded to that supply. We have several supply categories. And we are, one of the things with just being better at what we do is making sure that where we budget dollars, expenses are actually hitting that same category consistently. We have had different supply buckets. We have admin supplies, we have this supplies, and so we are in the 26 budget conversation. I think if you remember Ann M talking about some of that stuff, we're trying to basically consolidate where some of those supply charges hit. Okay. I have a question into John on his, John and Mark. Mark on the repair, trees, greens, and fairway work. That we had budgeted 153, which was just 150,000 of the 243. I know that number is gonna go up significantly with the pig damage. That they are, I think everyone knows about the pigs. The pigs got there going for the grubs, so that'll come up. But I do have some more questions for Mark just on the timing of that and some more insight. Once again, a question where the senior leadership team will provide these variances and get feedback from them. So I know that'll go up. I don't know exactly how much they're expecting to spend on the golf course damage from the pigs on the greens. And then also might be some timing issues on when he does it, right? So I would not expect to see though that there's a lot of work right here in the middle of the winter, but I could be wrong on that. I'm not a golf course repair guy. Okay, and then moving on to administrative expenses. Once again, supplies, small tools, a lot of that is also up in that other category. I spoke to that already. Going forward, those will have clean consistency to what is coded to that, because it's a varied, you have to realize there's a lot of departments that touch these gels, right? And so we need, as we look at some of the best practices and process and reset going into next year with these budgets, exactly what the coding police should be doing and making sure they're going to the right buckets. Yeah, Dan.
This is great. And once we get these type of packages from you ahead of time, we all do our homework. And then we can go back to a comment Harry made 9 months, maybe a year ago, that we can start maybe spending less time on the detail because we've done it, and more time on another issue, whatever those issues are that we want to spend a little more time on. And I think that would be really great. And the other question I have is, I'm assuming the new systems will allow you to prepare a December statement before audit adjustments, and we'll be able to see that with that. So we'll be able, so in the January meeting, we'll hopefully have through December.
We will still probably obviously have some accrual work.
Oh, yeah, absolutely.
Certainly, but yeah.
Yeah, perfect.
Yep,
Yeah,
we're not gonna get off sequence to our financials now, and we have these two additions, which is the thing we've been waiting for, so.
And then in January, we'll see January statements, even though the prior year isn't close.
Yeah.
Which you couldn't do in January.
Correct,
So,
but they will be.
Preliminary, absolutely, absolutely.
so in terms of digesting this information before the meeting, which Dan is talking about, I think that's really important. And I'm glad you established a threshold, because then we don't have to worry about minor differences. But in terms of variances, maybe before the meeting, you can have a short summary of what is the source of the variances which are above the threshold. I think the source is important, because if it's seasonality, I don't think we have to worry much about it, you know? And you have a better judgment about that, but if it's something more unanticipated and stuff,
That's why he's gonna start talking
Yeah.
to the people. If he knows all this stuff beforehand, he'll have time to talk to the person in charge,
absolutely, yeah.
get answers, give us those answers. Also, the budget will be better, seasonality.
Yeah.
And so hopefully, some of these variances will go away and then we can spend.
Time on issues.
Yeah, and if you take this and you look at this along with what's remaining in the budget, some of those variances, also are flattened or mitigated. And then to your point, we've also talked about, a secondary report in 26 where we go through a quarterly potential deep dive and we kind of dig in a little more to the variances in terms of if there is causation on what we budgeted. So to Dan's point, where we have a better seasonalized budget, we will still then have variance, and if those variants are, what did we learn from those variants and what are the causation of that variance in terms of our new thinking, so.
I think that makes a lot of sense to do a deep dive quarterly rather than every month.
Yeah. Yeah, we should, if we do our homework and get this package from Todd, we should, in theory, spend 15 minutes to 30 minutes on the financials on a
And then
monthly
move on.
basis, and that's it. Because we'll have a couple of questions, we'll go through it, and hopefully we'll be good to go.
Yep.
That'd be great.
And then Todd, remind me when we're gonna implement the forecasting process, like.
So, I mean, it was implemented in a lot of ways with the budget meetings, with the mutuals. For RWC and RPM, it'll be an exercise that we start with 2026, and we'll start forecasting, I think along with the quarterly deep dive, we would do a reforecast that year, so we'd have a reforecast after the first quarter, reforecast after June. We then, populate, from our budget calendar, we then populate July numbers, right? And then we would tweak so that we have a pretty, plus the culture of the team looking at the spending and what's left, that was a cultural shift for everyone to just look at, well, what bills will be coming in we were turned on purchase orders and things like that, right? So we can look at vendors and contracts and what's remaining. There needs to be a lot of discipline done on accruals and making sure that we actually have accruals and we actually, historically, we've had bills that might come in paid in January and therefore work that's done in the prior year. So we're gonna do a more robust accrual process this year as well, so that the 25 numbers really reflect everything that happened.
There you go.
There you go.
Okay.
Saved.
So, I have a question or a comment here. We have formed a KPI task force. Nancy is co-chair, Susan is co-chair. And it's working away over the next several months, attempting to bring forward a set of KPIs for the operation as a whole. When you look at KPIs, they seem to sort of separate into two or three or four categories. Operational ones, how many cars are you making each month? Customer satisfaction, do the customers like those cars? And financial, how is your organization doing? And so, there's typical things that you see in financial reports like current ratios and things of that sort. It occurred to me that this group would be better focused or better able to focus on the financial KPIs that we would like to see, because this group of people understand those things. And so I was going to suggest that in our next meeting, if we could come with some ideas about what KPIs do you think would make sense for this organization, given your history and experience with those things. I'm not, current ratio is sort of one of the ones that you always see.
Yeah.
But is it really a
Is it
key
applied?
issue for us? Because we're not really debt financed and, and so on. So the revenue things that are more important for us to be looking at than the sort of regular ones that you'd see in a typical public company.
Can you please put that on the agenda for next month's meeting, Deborah?
So,
I will.
Thank you.
Following on what Adrian is saying about KPIs, I was looking at the risk assessment big, laundry list we have. And I was looking at like 6 or 7 items are related to financial risk of some kind of fairly big magnitude, whether it's related to insurance or whether it's related to revenue diversification. Actually, the most important term in that whole thing was revenue diversification, and it came towards the end of the document. So in terms of the KPIs, I think some of the KPIs should measure some amount of systemic financial risk.
Yeah. And so that's a good example of something that might be more relevant for this organization rather than Microsoft.
It's on the agenda for next month, so that's homework for all of us to do for the January meeting.
Okay.
Okay?
Thank you.
Thank you. Okay.
Okay, real quick, there is a change that I want to talk to you guys about that I did over the weekend. As you guys know, Thanksgiving happened and we had people on vacation, as much as I'm excited to get all these documents out, there is also my own review of all these numbers, and there's a lot of numbers, right? So on the RWC balance sheet, I noticed that we had not, if you look down here under the current liability and the equity, right here where you see these big numbers, the 12 million and the 7. So just keep that number, the 5023 number in your heads. It's on your current documents. There was the defined pension plan that was hitting the current liquidity accrual and hitting equity. And so it does not change the balance sheet. It's a closed system. So the 5023 is still 5023, but I did go through and have Amanda make adjustments to remove the pension accrual that was in the other current liabilities section and balance it off in equity. And I'm just going to show you real quick what the new one looks like. Give me 2 seconds. All right. So let's see. Okay, so it actually was just needed to be corrected. Come on, borrow this real quick.
I'm afraid that's as far as it can.
Yeah, I know.
Motley looking crew.
I don't know.
Uh-oh.
Is that the last supper or something?
All right.
We have 13.
Okay, so this only affects RWC, but it will also affect the consolidateds, okay? It doesn't affect the cash flow or the income statements, but it affects let me zoom on this a little bit so you can see it. So you will see now down here in this equity section, you'll see that the current liabilities and the equity are now in
That
balance.
looks much
All
better.
right,
Right.
that makes sense.
So, and that was also one of the big pieces that tied to, obviously, the audit from last year. And we'll also have the comparative balance sheets we're working on so we can see the change. So I just want to let you know, so it's just the 2 changes in those buckets that needed to come out. Doesn't change the actual number, so but this is the accurate one. So I'm gonna swap out this balance sheet, which is in your current package, and I'm gonna swap out the new consolidated one as well. because obviously those same effects happen on the consolidated revised balance sheet, which is right here. And so I just want to let everyone know I couldn't do that, didn't make that adjustment until I had Amanda back in the office yesterday. Okay.
Okay, great.
All right, so just full disclosure there, so we're gonna change those two sheets out, but all the actual totals are all the same.
Okay.
Okay.
Is that it, Todd? Anything else? Anything else?
That's what I got.
Anything else for Todd?
Good.
Okay, that's great.
I think it's a big step forward.
Yeah, big step,
Yeah.
huge step.
Thank you, Todd.
Huge
Thank
step.
you.
Make sure your team's aware.
I will.
Yeah,
We appreciate it. It's a huge step. It's nice to have
so nice.
full packages. Jeff, do you have anything under the capital projects?
So the only thing to note, we are underway with the pickleball project, although you do not see a lot of activity out on the site right now. The equipment, the main product is being ordered. We have hit some supply chain slowdowns with the irrigation pipe, which is what goes in the ground first. That's kind of to be expected with everything going on in the world, but everything is on order in that portion. A big portion is actually taking place behind the scenes. So you'll see activity out there in the coming weeks, but we are experiencing a little bit of a delay with supplies. Other than that, the rest of the projects, we did complete the pool replastering at Tyson. That's now open. And the work on the bridges and the studies are kind of been on pause, but will resume here shortly. The budgets, again, as I mentioned earlier, for the capital moving into 26, what is continuing on and what is new is being evaluated at planning and will be brought to your committee at your next meeting.
Okay, questions? If not, MTF?
Plug back in, but I'm not sure why the screen's not coming up.
So as they're getting the screen back up, you'll see we've definitely continued the trend, downward trend this year. This is very reflective of what is going on in the real estate market, not just isolated to Rossmore. Sales this last year or this last month and for October, we had 27 fees paid on 38 total sales. If you go down to the bottom there, 11 of the exemptions were folks that previously paid the fees, so they were transfers within Rossmore, either people purchasing a second property or they were relocating within Rossmore. I know there is interest for us to expand on this for all of the exact exemptions that we permit under policy. That is still kind of within the works, but we're trying to get the new work order system implemented right now. So we are adjusting down kind of our projection for the year end as we do work through the capital budget for coming to you
Can you
in
go up, Todd?
26.
What's our total number for the year?
Our total number currently sits at 318 fees paid with 2 months to go.
What's the number that,
324 and
Yeah,
So you see, we've actually had more
more sales.
transactions. It's just we have
Just
fewer
transfer.
fees because a lot of the transactions are either
so our
transfers or
budget number was 400.
we budget based on 400. So we're obviously not going to hit that
And
number.
that 400 is also used in the capital funding
right,
going forward that you talked about, Nancy. And we need to talk about that, whether that 400 is still doable for 2026 and beyond. I don't know how much farther we can go than 2026, but who knows? So something to think about when we look at capital budgeting, whether we're gonna make the $400, 400 units.
We thought that was conservative.
Yeah.
No,
Although
I thought it was,
actually-
we thought it was aggressive, because we had 401, or some very small number last year, 347 plus 50, we had 399 last year.
Yeah,
So the 400 this year was, I thought it was aggressive. We talked about going to 375, and that kind of got shot down. And
well, it's interesting that year-to-date this year, we're at 422. Year-to-date last year, we were at 416
But that doesn't,
in sales.
right.
But that,
All it cares about
Yeah,
the
so,
fees.
so,
money in the
You-
bank.
so I'm
Do
just,
we have any idea why people are
Well,
not
11 of them, this,
within the company?
11 of them were either, like Jeff said, were either second homes or moving within the complex.
yeah,
We're trying to get more, moving from one manor to another manor. So we're trying to get more detail. It's on Todd's list. It's just,
Yeah.
obviously, they've made a good headway in this. So hopefully it's maybe can move up the list a little bit. But
yeah, because I mean, there's,
Well, are there some people that own maybe 4 properties or 5 properties? Is that what's going on? And they're trying to lease them out or something like that? I don't understand.
So you have a couple different category. It could be a flipper that has more than one property that they're working on flipping, which there is benefit to because
absolutely.
ultimately that raises the value of the stock.
and ultimately it gets sold anyway.
Yeah.
Yeah,
They can just keep flipping and never pay anything.
right.
Right.
But the new
Eventually,
person
the
who
new-
buys it, they're not gonna, flippers are trying to sell those units. So once they sell it to someone, that person pays
The
it.
new person pays.
Yeah, the flipper, yeah.
Some, though, there are some people that own multiple units. They may lease one out and live in one, or however they, for whatever reason, there could be multiple units belonging to one
Is
user.
there any idea as to whether it's mainly co-ops or mainly big ones? The big
It's
ones?
on
Can you
our-
tell?
We're trying to get that
Trying to
information.
understand where this is coming from.
Yes.
A lot of this too has to do with, the necessity for us to continue to work through and clean up our database as we move into NetSuite.
So we'd like to get the sales per mutual.
right.
Yeah, again, David, you're right. It's on Todd's list, but he's been working on the NetSuites and hopefully since.
Well, I mean, that
that's-
was done 2 days ago, but
Hopefully, since that is,
Right.
hopefully since that's now not quite 100% there, but almost there, we'll have time in the next couple of months to get to this.
And do we have any history going back where we saw big fluctuations, 15 years ago or 10 years ago, where all of a sudden it dropped off and then came back up?
yeah, I've been following it for a while and you look back at some of those numbers and you can see things like when Waterford showed up, for example, okay? And then there was a big spike, obviously, in fees. And then it sort of dropped off because it got sold with all of the,
Yeah.
and nobody was moving from there because they just moved in. And so you can see those kinds of fluctuations throughout. One of the things that would be interesting to see for the leasing is because we do collect that FUF fee or whatever we're now calling it.
Yes.
And if you added up the number of those, are they,
Can you go back to the statements, Todd? Can you look at the FUF fee? Can you look at
Yeah.
on the statements and tell us what it is?
It has been increasing.
Can you go back to the statements?
Something.
I think they were,
Facilities, it used to be facilities usage fee, but yeah.
What's it called?
It's in RWC.
no, I think why it was a blank screen is I closed it.
Should be in there, right?
Maybe something you had to expand the
Yeah.
detail.
You have to,
Yeah, let me just do it on the website. Let me just do it. real
Gotta be
quick.
another revenue, right?
it would,
Yeah, let me just do it real quick on NetSuite.
Okay,
So I have.
we'll move on while you're doing that.
Yeah, just
Anything else under MTF that we want to talk about? And I think David's asking you, if you had, how far back was your history? Do
Yeah,
you
how
go?
far back?
How far back do you go?
I've got numbers back to, I don't know. Oh, yeah, 05, 06.
Do you-
Oh, really?
I think
Yeah.
can you put something together that you could show?
Sure, yeah.
I'd be
Okay,
interested
If
to
it goes
see
down, it comes
trends
right back
too.
up. That's-
so you can do
Like
that, you
economic.
can do that for the next meeting?
Yeah.
Can you?
Okay, thank you.
Facility usage fee, we are at $250,874
Just do it.
through October on a budget of 210.
Okay, so did you hear that?
250.
251 on a budget of 210 for the, what's it called now, amenities fee?
Amenities, yeah.
Amenities fee? So we're up a little bit, we're up 40,000 compared to what the budget was?
It's not.
Not hugely?
No.
At 13.5, that's 3 units?
Mhm.
This is one above 10.
Anything else on NetSuite or planning committee? Otherwise, we'll skip them. And can we get the NetSuite project update off the agenda, Todd?
Yes,
Oh, yeah.
I would like to change it just to FSM, just because I do want to report in January how that is.
What is that?
What is that?
Facility Service Manager, it's the module to take over the work order service.
Okay.
Oh, okay.
So it's the second phase of the
Great.
NetSuite piece, so it can technically just be NetSuite dash FSM, but it should be reported on in January. We went live October, we're not gonna meet again until then, and we'll, hopefully have all the bugs worked out. But it included like purchase orders with vendors, so there's a lot of enhancements, so it would be good to update
Okay,
this
great.
group on.
All right.
And then it can hopefully go away.
Jeff, are you gonna do ERM?
We could do ERM. I think you're driving this
Oh, yeah.
ship here. So let's go to the first page. So this is a tool that we've been using to try and identify major risks to the organization, both from a mutual side as well as RPM and trust capital side. It is intended to be as comprehensive as we can be and cover a variety of different topics. This has been going on for a while. We take it annually to the audit committee, to the planning committee, to the finance committee, and review it with the board. It's a good tool also as we work on budgets, if there are areas. So we try and keep it updated in terms of actions that we've taken, potential future actions, and so forth. So I can either go kind of category by category, or if you've had a chance to look at it, we can address specific areas. What's the?
Well, I looked at it.
I looked at it.
So, can I offer one? thought
Yeah,
here?
absolutely.
Okay, this is on 7A18.
Say 18.
18. Because it's talking about the risk management that's not so much RWC, but it's the mutuals are really in charge of this. And as I think about this, and maybe I just don't know what's going on, but are there any meetings between RWC, the board here, and let's say the presidents of the mutuals to bring them up to date as to what we think are significant risks going forward that isn't really the mutuals have to take care of it. But because you're changing presidents and boards are changing and so on, I have the feeling that, new people coming into those mutual boards don't really understand as much as maybe we would think they should. So is there any way to communicate to the mutual boards and the presidents of them what we think in these risk management things should be taking a look at, and maybe just bringing it up to date to them? Do you do that, or?
So and that's part of the management agreement as well, for us to make them aware of potential items that we are aware of, that they want to consider. They also have a different process in terms of working with their building maintenance managers and identifying on an annual basis their work program and looking out over a 10-year window, doing their reserve study. So they kind of work on a different schedule, but in terms of, known issues, we bring those to them as well.
So yeah, I can jump in there real quick. We
Bring it to
definitely
them.
are always talking about those.
What way? How do you bring it to them?
So we'll do either in part of the budget process as they're looking at their reserves, if there's items that don't come up on the reserve study, if it is like, for example, one or two, I don't recall, they're working on their water lines right now. So there's items like that we will work with them.
Okay, because I just think that, you hear about some of these big problems that some of the mutuals have had, and there's a lot of money, and they get assessments and so on, and if there's anything we could do, to provide some guidance or thinking ahead, besides just at the board. I know when we go through the budgets for next year, and reserve study, that's where they do spend some time going over, where you need to think about things, but I'm just wondering if
Yaron, you're unmuted. Are you trying to interject?
If you'd like me to, I'd be more than happy to.
That'd be great. Go for it.
So what I can tell you is that, yeah, in the budgeting process, we are definitely working with the mutuals in their reserve study on all of these type of things: sewer, drainage, electrical, water systems. All of the mutuals are at the age where they either have or need to replace their electrical panels. So some of the mutuals have up to $400,000 in their reserve budget for replacing electrical panels. Drainage and sewers, we literally will tell them, look, you need to put at least $10,000 a year into this, because when we have a big break, it's going to be $50,000 or $100,000. So we're definitely talking about it constantly, and we're budgeting for it. And the transfer of boards is a significant situation, but we have budgets that go from year to year that span those directors. And then also, we never get a full turnover of directors all at once. So there is definitely historical knowledge that gets passed on from board to board. And we're constantly working with them. And like Jeff said, it is part of the management agreement for us to be working with the boards directly on whatever they would like us to work on. But we do also meet regularly with PG&E, East Bay Mud, and most recently I just made contact with Cal Sanitation. So I have a contact there now as well. We are working closely with all of our utility providers and our subsurface infrastructure providers as well.
Okay, good.
Great, thank you.
My pleasure.
So I have a general procedural question on this risk stuff. So when I look at the whole list of different kinds of risk, there's some which are directly related to financial risk. Ultimately, everything is related to financial risk indirectly, right? But directly, there are like 6 or 7 items, and I guess we have to prioritize in terms of risk reduction. What are the things we can do as a finance committee in terms of overall exposure to risk? So one of the things which comes in that long list is diversification of revenue. It seems like that should be a major priority, especially given the fluctuation and the lack of dependence of MTF. So what do you guys think in terms of overall assessment of financial risk?
What do you mean by diversification of revenue? Well,
our only source of revenue right now is the coupon payment or the MTF. The coupon payment is predictable, the MTF is fluctuating like crazy and not very reliable. So in terms of our long-term capital needs and stuff, the primary kind of way to reduce risk is to have some kind of diversification of revenue.
Yeah, which is hard to do here, unless you're gonna sell naming rights to the pickleball courts.
I don't know. I mean,
Something like that. I don't know if you think that's even allowed. Start issuing tickets and keep the money and that's my idea. I know.
One of the risk categories is Reduction of the membership transfer fee, so the risk description, significant reduction in membership transfer fees.
Which one you on, Jeff?
Commissions. I'm on page 8, which is 7A-8. So maintain a minimum fund balance in the trust is a proposed solution. So we've begun building a reserve. We're going to be at 4 million. So if we continue to put 250,000 into that on an annual basis to build up a higher reserve. Some proposed actions: curtail discretionary spending at the board's discretion. Evaluate marketing options to attract new residents, evaluate fee sensitivity to housing market performance. So there's a couple of different things in there.
Yeah, they're spread out in the whole thing, in different places.
As I understand, somewhere I heard, I can't remember where, that we don't necessarily have to fund capital projects out of the MTF. True or false? I mean, we could increase the coupon so it's a stable stream to do that.
You can collect higher assessments for capital improvements if that was a direction that you wanted to go.
It's not, yeah, so it's not written in the
The one before that has to do with the payment of the coupon. So if there was an event that materially disrupts the mutual's ability to continue to pay the coupon amount. So what we did, we increased our business interruption insurance from 5 million to 30 million. So if there was a earthquake or there was a catastrophe that prevented the mutuals from being able to collect from their members in order to pay.
So that gives us about a year's worth of complete interruption.
Which is without normal.
Which is, yeah.
So then we're the one before that, 7A6, capital availability, lack of affordable capital. So if we need to finance, so that's where kind of comes into what you were just saying. Do we raise the coupon to cover assessments, or the MTF, which we have done? So those types of things are included in the plan here.
So one of the action items indicated is developing an ESG framework. And I think the organization is doing quite a lot of stuff in terms of different kinds of environmental stuff already. So maybe establishing some kind of framework of collecting that data might be.
What do you mean by ESG?
ESG, environmental and social.
Sustainable governance.
Sustainable kind of stuff.
Okay.
I mean, most businesses call it sustainable, even ESG. Like different categories of things we have done could be part of a general kind of framework with some KPIs.
For this document, what is the risk that you're trying to identify?
So in terms of sustainability, it's always environmental conservation, which we're trying to do in some different ways, environmental risk, also economic viability, and then part of it, social responsibility.
But in terms of risks to the sustainability of this organization, what specifically are you trying to? So I'm trying to figure out how we can take what you're identifying and actually list it as a risk that we can then.
So the risks is spread out in a couple of items. One is in terms of fire and hazards. The other one is in terms of flooding. There's also stuff about landslides. So different kinds of geographical risk. Also, I don't know, you guys might have done this, but in terms of evacuation, is there a possibility of making a second evacuation site? Maybe like around the fitness center, there's a gate there. I don't know whether people can get out that way. So So that's,
So those
it's
are,
all part of environmental
I
risk.
think those are all.
those are all
That's all
identified
over
in here.
Emergency operations.
I think those are all addressed in there.
Yeah.
Yeah, but the question is to put it in a framework so that we can measure it on a consistent basis.
I don't know how you measure that. Yeah, I don't know how, I don't know how you measure that. Wait, I don't know.
Well, there are reports that some big companies do on
Right,
ESG.
ESG. Yeah.
But I'm not sure that,
I know they have,
you know, I mean, like Apple does a whole bunch of stuff.
we're not Apple. We're not Apple.
Yeah, and we're not Apple. You know, so,
I mean, didn't they have a fake evacuation?
They did.
A year ago,
mhm.
where people were on the parking lot, they were hurt and all this stuff, so they did a fake evacuation. And I know the evacuation, they have an evacuation plan that they're talking about, the second exit, that's a huge risk.
That's a huge risk.
No, I agree,
Absolutely, yeah.
I agree.
So I think having a
But I
plan for
think
a
that's
second
I think
exit.
that's in there somewhere. But I don't know.
Yeah, I mean, we have a extensive evacuation plan and safety plan,
Emergency operations.
emergency
plan,
operations plan. We do a lot of publications on that.
Staff training.
Yeah.
So, I mean, to plan a new actual roadway out of here beyond what we currently have, I mean, you're talking, I don't know, pick a number, $100 million. It's just, we don't own the property around us. We don't own any of the access, so.
And if you've ever driven up the road that goes up to the top of,
Stanley Dollar.
well, no, not Stanley Dollar, the other side. That road is a death trap,
Yeah, it is.
absolute death trap. There are big trees all along it. It is just covered in greenery. And if you were to go on this, the other one, on top of Stanley Dollar and down the other side, there's hundreds of houses. Those people are going to be evacuating as well. And perhaps they're going to come this way. The road goes two ways. And so, you know, it's not as when I think about it, it's nowhere near as obvious as it sounds like, oh, let's have another evacuation route. It would probably be a death trap like it was in Paradise.
If you look at 7A15, there's lack of ESG framework, risk description, failure to evaluate environmental, social, and governance factors could hinder.
Yeah.
Well, he's talking about one that you want.
Lack of ESG framework.
So the risk description, failure to evaluate environmental, social, and governance factors could hinder RWC's ability to align with industry best practices, attract partnerships, and maintain relevance with evolving stakeholder expectations. So within that, is there additional things that you would want to put into this category?
Well, for starters, I would put all the risks which are geographically related in that framework in terms of mitigation measures we're taking and some performance indicators we can measure for achieving. For instance, like fire reduction risk, right? Let's take one. So fire reduction risk, we have taken some measures like fire-wise category and foliage and stuff like that. So there needs to be some kind of a cost benefit in terms of the kinds of stuff we have done and the benefits we get in terms of reducing risk and lower insurance rates and stuff like that. So most organizations do some kind of an environmental risk kind of mitigation cost benefit analysis. That would be I mean, I'm not worried that much about the social responsibility stuff and stuff like that.
So this tool that we're reviewing right here really isn't for a cost benefit analysis. This is really identifying what potential significant risks there may be within, impacting the organization and Rossmore in general that should be addressed, or at least in the planning process, not necessarily the cost benefit analysis.
Well, except ultimately, we have to quantify that risk and try to measure what we can do about it. All the stuff related to environmental risk. I mean, it's there in the report. I'm not saying it's not there, but it's in different places. But there's no framework to kind of get our hand around it. And there are frameworks out there in terms of how to measure and create some kind of action plan for it in the long run.
So Harry, I update this document from the requested changes from each committee. Can you explain to me, I'm having a hard time tracking. In this document, if you look at this section, lack of ESG framework, is that sufficient? Or would you like proposed actions added, potential impacts or progress made? Do you want to tag in reviewing geological, fire hazard, flooding? Like, I don't know how to add the content.
So what I'm saying
In
is
which
that
section?
if you take the long list of stuff which is there, take all the stuff which is environmental related
Okay,
and put it in a separate category.
okay.
That's the beginning of at least the classification of what environmental is, right?
So a lot of those environmental sections, as you call them, they have other implications and other risks. It's not just the flooding. It also has lack of payment for HOA payments because all the housing is gone. There's different integral pieces for each one. So are you saying to make a whole new section, title it geological in relation to ESG, and then just list fire, flood, dun, 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 dun? Like, walk me through that,
So create a new category called environmental
okay?
and put all the stuff which is related to geographical kind of risk.
And then,
And we have to find better ways to measure it and better ways to mitigate it. Those are the overarching factors.
proposed actions is basically looking at ways to mitigate these certain items, but they already have all those mitigations on those sections. So how is this tying in? Do you understand? Maybe I don't understand.
Well, I think we can look at how things are organized
Organize
within the
yeah.
document.
So some of the stuff is interconnected. So
Yeah.
if they're in a particular environmental category, then the interconnections become more clear.
So maybe it's how things are listed
Yeah.
and organized, and one of the action items could be developed, so.
And I see financial risk all over the place too. So I think overall financial risk can be a category, and then you can put all the stuff related to financial risk under.
Yes, we can look at how the document is organized.
Yeah, so
Okay.
I think what Harry is saying, in effect, is that there are, you almost need like 2 or 3 tables of content. One saying, here's all the financial risks, look at A, B, C, Q, and R.
All the MTF, the
And
insurance and all that.
here's
We
the,
can
here's the
definitely look
environmental
how it's
one.
organized and searched.
Yeah,
Okay,
All right,
that would be helpful.
okay.
And here's all the ones that are related to mutuals.
yeah,
Yeah, mutuals is a,
yeah,
yeah.
They're a separate category.
They're a separate
Yeah,
category.
yeah.
I think
And therefore, what can we do?
Yeah.
Because you might look at all the environmental ones and say, oh, we can really do something about this,
Right.
but we can't do anything about that.
Um,
And so, oh, okay, we should do something about this. And I think that
Yeah.
having
Did you get
that vision of
Okay.
it would be helpful.
That's the first pass, and then
Yeah.
there are ways to measure different kinds of
Mhm.
potential risk and mitigation efforts and stuff. But I think if you put them in these 3, 4 big buckets, our priorities will become more clear in terms of overall strategy.
Okay, you got it? Okay, anything else? If not, our next meeting is Nancy, our next meeting is January 27th
I was gonna
at 9 a.m. Not, we don't have
I'll
one,
be
we don't
there,
have one. the
January
fir- We
20th.
don't have one the
We
fourth
don't have
Tuesday of
one.
December.
That's
Great,
great.
thank you. We'll see you all. Have a happy holidays if I don't see you.
Happy holidays.
Thank you, Dan.
So the meeting is adjourned.
Meeting is adjourned.
10:33.
All right.